Thanks for tuning in to this special edition of our weekly investment webcast, Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer here at Signature FD. Now, in today's iteration, what we're going to do is we're going to try to take a more narrow look at election cycles and potential election impacts before looking at some of the bigger, broader current macro and market trends. Now, an obvious caveat as we go into this is that this is likely to be an incredibly close election. And no matter what the result, campaign policies may not be the policies in practice over the next 4 years. Even so, let's try to dig into what we can regarding the election cycle. And maybe in a little bit of levity here, I'll start with this Oscar Wilde quote, in which he notes that politics is the art of looking for trouble, finding it everywhere, diagnosing it incorrectly, and applying the wrong remedies. Success in politics is often driven by evoking strong emotions from potential voters. But in investing, we're awarded no such flexibility, and emotion in investing can be a bad characteristic. So we're going to attempt to stay objective, historically focused, and indicator driven. So let's start with history's view of a traditional election year cycle. The solid lines in this chart show what's happened in the lead up to incumbent re-elections, while the dashed lines show what has happened in the year in which the incumbent parties have gone on to lose. Now, the black line is the average election year regardless of outcomes. Note first that election years skew positive, but have tended to be much better when the incumbent party has won re-election. That's been especially true when the incumbent was Republican. Now, the potential good news for investors this year is that the range of outcomes has tended to be much more narrow when the incumbent has been Democrat. That might have something to do with the Republican focus on the economy. When the economy has been good and markets have rallied, Republicans have won re-election. When the opposite's been true, Republicans have tended to lose the re-election bid. Now, we're not big believers in cycle analysis, but there's been a pretty stable 4-year presidential cycle that's tended to play out in markets. So what we're showing here is a full 4-year cycle in blue in the upper chart of this clip. And in the bottom clip of this chart, we're showing a fiscal and monetary policy composite. So really what we're showing is that combination. When it's on the way up, the fiscal and monetary environment is stimulative. When it's on the way down, it's less stimulative. And what we can see on the right-hand side of the chart is that heading into an election year, stimulus really starts to pick up, and it generally continues a positive trajectory until near the election day. Now, this year has been a bit different. We've actually seen a pretty big contraction in stimulus for 2024 because federal expenditures are down, receipts, or better known as taxes, are up, and Fed policy has resulted in a contracting money supply. So the market has bucked that fiscal and monetary headwind this year, and we can probably attribute that to a still solid labor market and easing of credit conditions. So the slide before, we showed that fiscal stimulus is actually down, and it's certainly, but it's certainly not out. And I don't expect that you can read all of this on this slide, but what this slide is showing is it's just showing some major policy proposals from Harris on the left and Trump on the right. Now, both candidates do not seem to be afraid of running deficits. Of course, they get there in different ways, but the net effect of either policy mix is going to be fiscal budget expansionary. So let's look at potential impacts. Let's take a look at some potential impacts here from a market perspective and to corporate earnings. So this chart here is showing after-tax corporate profits. And what we can see in the top clip is that profits net of tax are at a record high. They've grown a little over 11% year over year using data through Q2. Now, the Harris proposal calls for a jump in the corporate tax rate from 21% to 28%. The Trump proposal would drop it to 20%. Now, in a vacuum, that would mean a headwind to profits under a Harris administration and maybe a slight tailwind under a Trump administration. We don't expect the impact to be close to the original Tax Cuts and Jobs Act, however, even if it's a Trump administration. Now, keep in mind that the corporate provisions were permanent, so Harris would need to get congressional approval to change the rates. Now, according to some recent analysis from Goldman Sachs, Harris's policy would result in about a 5% hit to the bottom line, while Trump's could be as much as 4% positive if he lowers domestic company rates all the way down to a proposed 15%. Now, another consideration, the Harris plan calls for a higher tax on share repurchases or buybacks. Now, the top two clips of this chart is where I'd focus. The top in blue shows total dividends paid through time. The black bars in the second clip show total repurchases. Note that today, repurchases are actually a bigger use of cash than dividends. Share repurchases are generally more tax efficient and a more tax efficient return of capital to shareholders because they work to boost earnings per share and therefore stock prices rather than providing an immediate dividend income. If companies decide that the repurchase penalty is too onerous, they could go back to dividends, which could have a negative impact on per share earnings. Now, muni bonds are another area that could see an impact from the differences in policy. Today, the highest tax bracket investors should probably prefer muni bonds to treasuries and even to corporate bonds in some cases. Now, if income brackets go up, that means if income tax brackets go up or the taxes on different income brackets go up, that means that demand for munis would also likely go up, suppressing yields and at least temporarily boosting muni bond prices. So let's start to unpack some economic considerations. At the end of the day, corporate earnings and share prices will be far more influenced by the economic trajectory than tax policies. But let's start with housing. So housing is an important consideration because we're drastically undersupplied in the housing market. The blue line in the top clip of this chart shows housing supply and includes a dashed black line for where housing supply would have been had it followed its long-term trend. So this estimates that we're nearly 2 million housing units undersupplied right now. This is the main reason that shelter costs have not normalized like some other areas of the inflation basket where supply has essentially returned to normal. So the Harris plan focuses on supply through tax credits and deregulation and also through government investment. The Trump plan also has a focus on supply through tax incentives, but also, even if indirectly, the demand side through the curbing of immigration. For either candidate, if they want to put a lid on inflation in the next 4 years, shelter will likely be something that is worth targeting in their future policy mix. So let's unpack the potentially politically charged immigration trends a little bit. This chart goes back to the breakout of the pandemic, and it shows labor force growth of native-born workers in blue and foreign-born workers in orange. Note that all of the growth in the labor force has come from immigration. All else equal, a rising labor force is disinflationary as it keeps wage pressures down, and it is growth positive because a country's output is simply the amount of workers and how much each of those workers can produce. Immigration trends have likely been inflationary for shelter, but disinflationary for most of the rest of the inflation basket. Now, the two candidates clearly have differing immigration policies, and there's going to be impacts on inflation regarding those immigration policies. Now, the good news through the differing policy mixes is that under either regime, at least over the next 12 months or so, we're likely to have an environment where the Fed is generally accommodative, and that fiscal policy will also be accommodative. Historically, when that's been the case, the markets tended to perform better than average. So I won't bore you with all of the details from this chart, but that's really what this chart here is describing, is that when the fiscal mix and the monetary mix have both been positive, stocks have tended to perform well. And when push comes to shove, the market's been able to perform well under a variety of political mixes. This chart is showing the different mixes between the presidency and Congress. And what you can see here is that stocks have averaged a gain under all of these mixes. Polling is very tight, and the outcome of all of these races may not be known for weeks until after the dust settles. But hopefully this does give clients some comfort that the political mix is not typically the main driver of investment returns. Now, one thing that has been pretty consistent, given the uncertainty that is inherent in election years, is that defensive stocks have tended to outperform heading into an election. And that's all this chart is telling us here, is that the staples sector, healthcare sector, utilities, and telecom stocks have tended to perform better than cyclical sectors like energy, materials, consumer discretionary, or technology as you head into an election. However, historically, once you've gotten past the election, some of that uncertainty is removed, and those cyclical stocks tend to start performing much better again. So let's close things out with a few final economic perspectives. First, the economy is again surprising many forecasters this year, and it's really been a lot stronger than expectations. Now, I think one of the big problems in this cycle is that economists and market strategists are looking at traditional leading economic indicators, which just haven't been the right set of indicators to watch. What we're showing here is that the economy in blue in the top clip, and note that it's continued to trend higher ever since the pandemic. Now, growth may eventually begin easing, but what we should be careful is not to confuse normalizing growth with a recession. The data is simply not yet recessionary. Now, helping the economy along has been a gradual lessening of inflation pressures. The underlying fundamentals for inflation suggest that it should remain benign for the foreseeable future. And that's because unit labor costs are quite low right now. Companies have gotten wage growth to a more controlled level, and productivity has been improving. Now, providing support to the labor market, profit margins bottomed in 2022 and have been working their way higher ever since. So there's kind of a fortuitous cycle going on right now where higher levels of productivity are helping to offset wage gains, and that's providing support to corporate profit margins, which in turn inspires companies to maintain their employment. So an economy that's still chugging along is supportive of what we would call a slower policy easing cycle. What's important here is Fed policy going forward. So what we're showing in this chart is we're showing different Fed policy easing cycles and whether the Fed was easing policy aggressively and quickly or whether they were able to ease policy slowly. So if you look at the blue line here and the orange line, that's what we're talking about. The blue line are the cycles in which the Fed was able to ease rates slowly because the economy was still doing well. The orange line is when the Fed had to cut rates quickly because there was a recession. Note that the market has done much better under these easing cycles when the economy has continued to expand, and that's currently our base case. Now, regardless, I'd always want to remind clients that we set up portfolios for the long term. This is an interesting graphic that shows the annual market returns if you are an investor starting in each year across the top row. Now, down the y-axis, that's how many years invested from that starting year. Note that for the most part, annual returns have not stayed negative for much longer than 5 years, even investing starting at the worst market cycles. And by the time you get past a decade, you haven't experienced a negative annual return. The growth portion of your portfolio should have a long-term perspective which extends beyond any presidential term. That's just one final PSA that we would add. So with that, we hope you found some of this information useful. It's certain to be a tight election, and we'll follow along every step of the way, analyzing market trends, as well as personal financial planning implications for you. But as always, we want to thank you for taking your time to join us. and wish you a great week ahead.